What interest rate hikes mean for your finances. Interest rates impact every part of finance in our lives, from mortgages to your 401k to stock market investments and credit card debt. In this video, we're going to look at what the recent interest rate hikes mean for your finances and life in general, and what you can do to minimize the impact on you and your family. In the USA, the Federal Reserve announced that it is raising interest rates by 0.75 percentage points following the September 20th to 21st meeting, bumping the federal funds rate to a target range of 3 to 3.25%. In the UK, the Bank of England has announced a half percentage point interest rate hike to 1.75%, the biggest increase in 27 years. These interest rate rises are designed to try and get a grip on inflation, which is currently out of control across the globe. Interest rate rises are the one thing which impact us the most financially, from borrowing to investing and saving and spending. Interest rate hikes impact every part of our lives where we are spending money. The only real beneficiary of interest rate rises are with the large savings accounts, but the interest rate paid on these accounts doesn't reflect the actual base interest rate rises. So in this video, we're going to look at how interest rate rises impact us in various parts of our lives financially, and what we can do to offset the impact on us all. Before we get into it, please hit that subscribe button and comment "I subscribed" below, so I know who is serious about their financial future. Subscribed? Okay, great, thanks. Many people all over the globe are adjusting their budgets to cope with rising inflation, a looming recession, all-time high energy bills, and gas prices. In this video, we're going to look at how these latest dark clouds over your financial well-being will impact you and what you can do about it. Please remember, though, that I am not a financial advisor. Everything I talk about on my channel is from my own experience or my own opinion. Seek the advice of a professional before making any financial decisions you are not 100% sure about. Firstly, let's start with the main costs people are impacted by, and this is your mortgage rate. It doesn't matter if you are a homeowner or a renter. Mortgage rates will impact you the same. Landlords will likely have a mortgage on the house you're renting, so interest rates will impact them. Even if they don't, the rent in your area is likely to increase to stay in line with the other houses in the area, which will have been impacted by the interest rate increase. Loans for homes are seeing a huge increase, and many people who are coming to the end of a fixed-rate deal on their mortgage are going to be in for a real shock. If you fell into a new mortgage rate deal around 12 months ago, you're pretty lucky, as you aren't going to find any great ones out there at the moment. If you can remortgage into a better deal than the variable rate looks, you're best doing that as soon as you possibly can, as I don't think the near future for securing a great deal is going to look all that great. And the longer you leave it, the worse it may get. If you have a good loan-to-equity ratio on your house, you can get some better deals. But if you're new to buying a house or are actively looking now and don't have a hefty deposit, some of these deals are going to be hard to come by. So what can you do about this? If you can afford it, the best thing to do is to start overpaying on your current mortgage. If you're currently in a fixed-rate contract on your mortgage, make sure you check with your lender how much you're allowed to overpay per year. This is usually set around 10% of the mortgage balance. If you are on a variable rate, you're free to pay off as much as you want per year without financial penalty. But still, double-check with your lender. What happens if you are looking to buy a home in this economic chaos? Well, this could be good news for you. As mortgage rate increases, house price growth is likely to slow down, meaning that the house you wanted may be cheaper than 12 months ago, or is not increased as fast as house prices were doing before the interest rate rises. I would recommend buying sooner rather than later, as there is every chance that mortgage rates can increase further. And as I have said in previous videos, make sure you are within your monthly budget and you have allowed for a large interest rate rise so that you know you are safe if interest rates get out of hand in the future. Now let's take a look at credit card debt. If you are a regular viewer on the channel, you will know that I advocate paying off all high-interest debt before you do anything. But you don't need me to tell you that this is a sensible thing to do. Base rate interest hikes will hit your credit card debt even more than the extortionate rate the credit card companies already charge. Your lender is duty-bound to tell you about any interest rate increases they are applying to your credit card, so you should receive a letter to tell you about this when the time comes. Never pay the minimum amount on your credit card debt. Always pay as much as you can. Please try to avoid spending on credit cards unless it's an emergency or you have the intention to pay it off in full when the bill comes. Prioritize paying off the highest interest rate debt first, and if you can, try to consolidate the credit card debt onto one card. If you have a good credit score, you may be able to do a balance transfer to a 0% introductory credit card, which could, for a small fee, allow you to pay off your debt interest-free for up to 24 months in some cases. Divide your balance by the number of months you have as an interest-free period and make sure by the end of your introductory offer, you have paid off the credit card in full. This will save you a lot of money in interest payments. What do interest rate hikes mean for car loans? The interest rate on your car loan is likely to increase too. Most car loan rates are based on your credit score, so it's important that you keep your credit score in check, as should be your priority at any time, but especially so during times of financial chaos. Obviously, if you are on a fixed rate for your car loan, the amount you pay should not increase over the agreed term. But when you come to get a new car or renew your loan, that interest rate will have increased. So make sure you keep your eye on your credit score. Make sure you don't have any credit searches on file months before you're looking to make a big purchase. This will ensure you get the best rate possible on your car loan. Before we continue, if you are still watching this video, congratulations. You are one of the few who really dedicates the time to improve your financial education. Please hit the like button and subscribe. It really helps me to bring you more great content. And don't forget to follow us on Twitter too. There's a link in the description below. Thanks. How do interest rate hikes impact the stock market? When interest rates are raised, in simple terms, it means that borrowing becomes more expensive for individuals and businesses. While the interest rate increasing doesn't directly impact stocks, the stocks are indirectly impacted because there's less money around for consumer spending. The less money people have to buy products, the less money the company makes, and therefore their stock price will suffer as a result. The stock market reacts to the changes in the interest rate because interest rates generally signal the strength of the economy. The interest rate change will also change a company's costs to conduct business, and therefore may change how the value of that company is perceived by investors. As has been the case for the past few years with interest rates at an all-time low, it has been easier for businesses to branch out into new ventures because the cost for borrowing is so low. If the cost for borrowing is higher, businesses tend to not want to try to venture into new things, as the risk is much higher. Therefore, any growth for innovation is stifled by the cost of borrowing, and businesses tend to stick to their core competencies, meaning that chances for stock price increases are lowered because they are not breaking into new markets, developing new products, and driving the company forward. Although the interest rates rising will cause the stocks to fall, it's important to see the opportunity here and grab some bargains if you can afford to. Stay focused on long-term investing and keep buying while the stock prices are low. This way, when they return to previous levels, you'll have made some great gains in your portfolio. The thing to remember is that in times of low interest rates, consumer spending gets out of hand, and it's only a matter of time before the government must rein it in due to inflation. Looking at what has gone on in the world over the past 2 to 3 years and the amount of money which has been artificially pumped into the economy, this current economic crisis was really inevitable. Since the Bretton Woods Agreement collapsed in July 1973, where the value of the dollar was tied to the holdings of gold and all other currencies were pegged to the United States dollar, governments all over the world have been able to continue to print money as they wish. For every dollar printed, every dollar in your pocket is devalued because there are more in circulation. But that's for another video. If you would like me to go into this in more detail, let me know in the comments below. Let's take a look at pensions and 401ks. To put it bluntly, the rising interest rates could cause the value of pensions and 401ks to fall. This is likely to happen as a result of falling bond prices and falling stock prices, which is usually what happens when interest rates rise. Higher interest rates are typically not good for stock market investors, which include millions of pension savers. Most pensions are invested heavily into the stock market, so if the markets are down, chances are your pension pot is heading the same way. Remember, though, that pensions are long-term investments, and unless you're retiring at this exact moment, the likelihood is that this won't impact you if you aren't retiring for years to come. For people who are looking to retire in the near future, think twice about if this is the right time. Maybe work a couple of extra years to ride out the storm and carry on contributing to your pension pot. For those who are drawing on their pensions now, if you're not drawing the whole thing out at once, the likelihood is that this will have minimal impact on you. The balance may have dropped for now, but you'll be drawing the pension over the next 20 years. In a couple of years, everything will hopefully get back to normal, so don't panic. There's nothing you can really do about the rising interest rates on your pension, but the worst thing you can do is to stop contributing to it. Keep your head down and keep contributing to your pension, and when the markets recover, so will your pension pot. Let's look at some good news. Interest rate increases are good for people who have savings. Rising interest rates mean that the rate which the bank pays you on your cash deposits in your savings accounts will also be higher. But holding cash is never really the best idea unless interest on your savings is around 10%, which it will never be. With inflation skyrocketing currently, you will still be seeing negative returns on savings account interest, as the inflation figures will erode any gains you make with the interest. It's far better to have your money invested into the markets with a long-term view so that you can capitalize on the gains as the economy recovers. Watch this video next to continue your financial education, and I'll see you in the next one. Don't forget to like, share, and subscribe, and share this video with your friends. Thanks for watching.